the Vice President at IIFL Securities, joining us this morning. Very good morning to you, Viral. Thank you so much for being part of the show and joining us here in the studios. And let me, first of all, I want to understand the entire setup that is there for the NBFC space. We are done with the Q3 earnings, and there are a lot of hits and misses when you talk about the NBFC space. For now, how's the setup looking like?
So, see, NBFCs, I would say now we are in a realm where we need to differentiate between different NBFCs. You have fixed rate NBFCs, floating rate NBFCs, primarily HFCs. And in terms of the broad theme that we are now going ahead looking at it is that there is going to be a continued moderation in growth. The asset quality is in pockets still actually worsening. In some pockets, there are some signs that it could be peaking or it's closer to peaking in a couple of quarters. And in some other segments, we may see that the tailwinds of rate cuts that RBI has done probably will flow through in the numbers, though of course it's built into the expectations already.
From 2 years I'm hearing buy L&T Finance, buy Mahindra and Mahindra Finance, up to turn aayega. The problem is that the turn is not coming, right? I thought it would be like a Hindi movie, good start, bad interval and then great ending. But it's stuck at the mid path. It is just not turning. The business is not turning. Why is that?
Thanks, Nikunj. You brought that up. So we have been negative on both the names since last, I would say, 1.5 to 2 years. Mm-hmm. And the primary reason why it has actually not kind of made that transition is to do with the function that the businesses that they tried to get into to diversify their loan book, those are either actually margin dilutive and ROA dilutive, or they really have not been able to diversify. So if you look at
an example, when you say they got into businesses, what were those businesses which they got into?
So if you look at, say, for example, L&T Finance, right? Close to I would say 3 to 4 years back, they embarked on this retailization journey wherein they defocused the wholesale book and wanted to become the retail player. Now within that, they focused on their existing segments which were there, but they were actually highly profitable, but more riskier segments, MFI, then personal loans. Of course, they also, to give them credit, got into the mortgages piece. But having this disproportionate concentration and share of such more riskier segments is what is actually coming to haunt them. In case of Mahindra Finance, the issue has been more about two things. One, them not having been able to diversify into the new segments. It has been a vehicle finance player, continues to be the same, with very high dependence on and linkages with the parent. And secondly, also to do with overcommitting and under delivering.
So let me classify NBFCs into some very broad pockets. The safest HFCs. They are steady, they grow, but they are expensive. Second is MFI space, completely bombed out. And it could be a long winter before the business turns. Then are these corporate back NBFCs, L&T, Aditya Birla Finance, Mahindra Finance, Sundaram Finance, which essentially get advantage of cost of borrowing, but some of them are very confused. They don't know what to do. They need to hire better managers. Then you have pure wholesale NBFCs. Those NBFCs largely only lent in the wholesale market, and there are a couple of them. Which is the best NBFC sub-bracket according to you in these 4-5 categories I mentioned?
I think the piece on the housing finance companies, the mortgage lenders, and the corporate backed ones, but ones which are fairly, I would say, well known, and ones who have been able to deliver, both in terms of, you want to look at diversification, in terms of, say, growth, in terms of the ability to deliver that returns. So you have, of course, the examples of Cholamandalam Finance, Bajaj Finance being the OG of that segment. But that is the space, because inherently, see, what happens is in any NBFC construct, right? Asset side is very critical. But what is also critical, even from your returns perspective, is the liability side. Unlike banks, you don't have access to deposits. You need the corporate parentage. And it's either a black and white, right? You have it or you don't have it. Because it's not just cost of funds, but also the ability to lever. Because that is what will determine your ROEs.
Okay. We missed on one. Guess which one?
Yeah, the corporate lenders of NBFCs.
We missed on the big one. Guess which one? My bad, we missed on it. Gold.
Gold, yeah.
But how can we miss on that? Gold NBFCs.
So see, in case of gold NBFCs, there is a segment where now probably, again, not from a near-term perspective, I think the biggest tailwind for the sector has been gold loan prices, and not just tailwind, that is the primary driver of that segment which is there. But say from a 2 to 3 years perspective, if I look at it, I think this is a segment where the competitive intensity may now rise. There will be a second round of competition coming in. The reason why I say this is because we had first round of competition from banks post-COVID when RBI relaxed the LTV norms. Then the market kind of settled, and there was a stratification that happened, that these are the bank customers, these are the NBFC kind of customers, right? So there was no point in going and chasing those customers and diluting your profitability. Now the second rung of competition that can potentially come is basically from the NBFCs themselves. So you have the other NBFCs. So one of the example that you took, L&T Finance, they are getting into this segment. We have Cholamandalam Finance getting into this segment. Of course, Bajaj Finance has built a fairly large book already, and you also have the others likes of your Poonawalla and all, everyone wanting to get into this segment. So within the NBFC cohort, I think over the next 2 to 3 years, we are going to see the competition now coming in, and that can potentially dilute the returns.
All right, Viral, we have been talking about the stress in the microfinance institutions, and as an institutional body, a lot of these steps have been taken to actually protect that. There have been some guardrails that have already come into play, and the latest one expected in April. Help us understand that how is that expected to impact the short and the long-term prospects of the industry overall?
So see, I think Nikunj remember this last time around when I came, I sounded out this caution that we are still not out of the woods, and we continue to maintain that. So first of all, these guardrails, right? These are guardrails that were reactive. They were not proactive guardrails, right? So there was an over leveraging issue that came through. And then you have put into this place. Now, of course, it has already been extended once. If it comes in, I think there is going to be again the next round of pain from a near-term perspective. But I think from a medium to long-term perspective, that's the right thing to do. In terms of how this will pan out, I think there are even more challenges now that are emerging. So as we saw that we had the ordinance in Karnataka state, that has really impacted many NBFC MFIs, not just NBFC MFIs, but MFIs in general. Different lenders have anywhere between 10 to 30% of their exposure in this state. And what happens is that this is the first time after the AP crisis, we have a state government coming in with a legislation. Of course, it does not impact the NBFCs or banks because it specifically excludes them. But it's very difficult to tell on the ground the borrower to make the distinction between the registered and the non-registered or non-regulated entities. So we are already, our channel checks indicate that the collection efficiencies are down by anywhere between 5% to 10 percentage points. And on top of it, the recovery also in some of the states is actually lagging behind. So you take Tamil Nadu, where clearly over leveraging issue was even a bigger problem. Those are the things I think that is still going to take another few quarters to play out.
Right. And since you did speak about the MFI, there is a stress in that. And given the fact that the lenders or also the NBFCs which have exposure to these MFIs, I believe they are also at risk, right? So when you talk about your pecking order, which are the ones that you should watch out for carefully, given the fact that there could be a chance of an accident there?
So see, at least within the listed space, few of the entities which are there, right? They have strong backing of financial investors, and those are the places where had it not been there, probably there could have been some risk. But given the strong financial backing, I don't think that there will be an accident amongst the listed space. But definitely there is a very big tail in the unlisted space. There is going to be a consolidation that will happen. And actually, to add to that, what is also happening is that earlier what we used to look at the over leveraging piece, right? 4 or more lender associations, borrowers borrowing from 4 or more lenders, that stress is actually now spreading to the borrowers who have borrowed from 2 or 3 lenders also. So there is a contagion that is happening. So if you look at the 30 plus par for these borrowers that have actually gone to 8%. This is what it was say a year ago for what we currently define as over leveraged customers. So I think there is further contagion or further, I would say, stress that is going to emerge in this segment. Broadly speaking, this entire segment, I would say lenders who have direct exposures, whether it's NBFCs or it's SFBs or a bank, depending on to what extent is the portfolio exposure, probably I will be cautious in this entire space.
All right, Viral, with this we'll let you go on that. Thank you so much for taking the time out and coming all the way to chat around what's been happening within the NBFC space as well as specifically MFI space as well. Really appreciate it.
Thank you.
But with this, viewers, let's move on, and time now for the big call from the big